Welcome to our YouTube channel, Moneyline with Nancy TV. This is where you get the latest updates on business, finance, economy, market, as well as investment information. If you couldn't follow us live on television, please do subscribe to our YouTube channel. Also, press the notification bell so that you can get notifications. Thank you. Enjoy this video. A very warm welcome to you out there. Good morning, everyone. Good afternoon, good evening. It depends on where you are joining us from and whether you're watching via your television set, online, or even through your mobile device. Good morning. It's my absolute pleasure to welcome you again. I am Nancy Naji, and we're continuing the coverage of the Washington meetings, of course, the annual meetings of the International Monetary Fund and the World Bank. So don't get bored yet. I know you've been seeing it for a few days now, but I hope you've been getting informed as to those crucial meetings, and especially the role Nigeria plays on the global stage. Indeed, that we saw high-level meetings even from the central bank governor, Mr. Olayemi Cardoso, as well as the Minister of Finance and Coordinating Minister of the Economy, Mr. Wale Edun. On a daily basis, there's been back-to-back meetings with the fund, with the World Bank, with the international community, with investors, with everyone that has been here. Like I've mentioned, we've seen heads of states, we've seen regulators, we've seen top-level managers, we've seen CSOs here. The who is who in the development and financial community here at this meeting. So don't get bored. All you need to do is to fasten your seatbelt again and join us on this ride. Today, I will be taking you through the press briefing that was done because even at the end of all of this, what is being done, of course, the finance minister as well as the central bank governor speak to journalists. So both officials do speak to journalists, and we didn't just have them only in the room. We had the Minister of Finance, of course, the central bank governor, the deputy governor in charge of economic policy at the Central Bank of Nigeria, Mr. Sani Abdullahi. We also had the DG of Debt Management Office, Ms. Patience Uniha, the alternate executive director of the World Bank here, of course, in Washington, our former finance minister, Mrs. Zainab Hamed, in the room. We also had Senator Jimo Ibrahim also joined us for that press briefing. We also had other people that joined us in the room to listen to what the Minister of Finance as well as the central bank governor had to say, chronicling what has happened in the last few days as to what is the stake of Nigeria, what are the key takeaways, and what are the actionable things that we expect after this meeting. So you will get to hear that today. But let's quickly take a break, and when we return, we will continue with the program. Don't forget to join us on all our social media platforms. If you are not subscribed to our YouTube channel, please do that right now. We beg of you to do that. Moneyline with Nancy TV. Let's take a moment. We'll be right back.
The Zuba International Market Traders Association in Gwagwalada Area Council, Abuja, called a press briefing on Tuesday, 29th October, to speak on the current dilemma of their traders, as well as the current lawsuits which they have undertaken against Lion Property Consult Enterprise Limited on the revocation of their 300 shops in the market. The traders shut down their shops to attend this meeting in pain and solidarity to the situation. The issue began in 2023 when the traders had paid for verification and validation carried out by the developer, which was supposed to cover a 5-year term. However, they have yet to receive their allocation papers. Usman Mustafa, chairman, ZIMTA, gave a breakdown of the genesis of the situation.
Somebody came to the market through our former escorts, introduced himself as a developer, which sent by the area council to the market to come and renovate, upgrade, and manage the market for 5 years.
Henry Ezianoche, vice chairman, ZIMTA, spoke on the various payments made to the developer.
Then, after he have sold these shops, we now came up with a revalidation exercise, which he told us we normally do every 5 years. Every 5 years, based on the condition in our location, our tenancy and our location will be due for revalidation. So formally, we pay 5,000 for 10 years. Later, area council made it 5,000 for 5 years. And now when the developer came, he turned it to 10,000 for the 5 years. And then, after the developer did this exercise, we are now expecting our new allocation. Only for him to come to some section of the market and said they should pay a certain amount, some 200,000, some 100,000, for that he want to capture them in their design exercise, of which many people paid to him. And he started meeting some individuals and started collecting some monies, which many of us doesn't even know some of these monies he's collecting to people in many grounds.
Erebo Sanami, head of practice, God of Justice Chambers, gave more insight into the legal proceedings so far. Izianoche provided more insight into the situation.
The allocation papers that they were having were collected from them. Now he has refused to give them their old allocation papers, and he has refused to give them new allocation paper, because before, once verification is done, once they revalidate, they issue you a new letter of allocation. So now, stylishly, they have collected all the allocation papers from the traders.
All this payment is meant to his own private account, which is contrary to the previous exercise we normally do in the market. Because during even that 2018 that he revalidated, we were giving an account direct to the area council, which many of us paid and obtained our receipt and teller. But his own, every payment, he channeled it to his own private account, of which many of us have fall victim. Even me, that he sold shop to, I paid to his own private account, and I have my evidence. Then, when he told all the traders again that we'll start paying 3.5 million and all that, we decided to verify from the area council.
The affected shops are currently marked for demolition. The association is begging all relevant government officials and the people, as well as Gwagwalada Area Council, to look into the matter. Precious Opone, Moneyline with Nancy.
All right, welcome back. Let me just allow you to hear for yourself how the Minister of Finance and Coordinating Minister of the Economy, Mr. Wale Edun, captured at these meetings. His sense of what the meeting is about, the key takeaways that he, of course, from these meetings, and of course, Mr. Olayemi Cardoso, who is the central bank governor, also captured the essence for him at these meetings. But let's take the finance minister first. After that, we'll take the governor of the central bank. Then you will get to see questions. Of course, as journalists, we ask questions. We were in the room, so we asked questions on, for example, when are interest rates coming down? I particularly asked that question, when are interest rates coming down in Nigeria? Because not just incomes are being squeezed, people are being squeezed, families are being squeezed. We've seen global inflation trending down. Global central banks are bringing down their interest rates. They are easing, and we're seeing a little comfort in the global economies, but you can't say that for Nigeria. So I asked that question particularly. There were also questions around what are the key takeaways. There were questions also to the central bank governor as to, okay, he actually mentioned what they're doing with the diasporan community, that the diasporan community will now be able to do their BVNs, that they're going to come up with a product for that. So let me just hold my fire, take a look at that, and I'll be right back to launch another key event, which was the annual plenary, where you will get to hear Kristalina Gogevia, the IMF chief, as well as AJ Banga are speaking. But let's take our people first. We'll be right back.
You're almost welcome to this press briefing. It's been a very interesting and an intensive week of conversation at the highest level about the world economy, its status, its direction, and various inputs as to the policy prescriptions. In a nutshell, the world economy is characterized by the developed countries, the advanced economies, having effectively combated and defeated inflation. For those economies, inflation is close to their target level of 2%. In places like Italy, it's as low as 0.75%. And on that basis, they feel that they have avoided recession as they have fought inflation, and in fact, they're headed for a soft landing where the economies are growing, albeit slowly, on average around 3.2% globally. But it means that they are now easing their monetary conditions, which were very tight before, and of course that led to high interest rates. For us in the emerging markets and developing economies, there is still relatively high inflation, so that effort has to continue, is the majority view. And at the same time, debt levels are relatively escalated, so care needs to be taken there. And in addition, growth is low. So at the same time as we try to make sure that inflation, which of course needs to be combated as a priority, we all know the negative effects it has on purchasing power and on living standards, particularly of the poor and the most vulnerable. But at the same time, critical investments must go on so that you have a chance to grow. Because at the end of the day, it is growth and job-creating growth that leads to a reduction in poverty, which is the major aim of the economic policies and strategies of President Wale Edun. And in presenting the picture in Nigeria, in updating the world on the status, we have pointed out that Mr. President's economic reforms are yielding fruit, are showing signs of progress, both in terms of inflation being down from its major highs. The budget deficit is down compared to in the first half of 2024 compared to the first half of 2023. Likewise, debt servicing is down, and importantly, the trade balance is positive, the current account balance is positive, so there's something to build on in terms of as we look to grow the economy through attracting investments. And as we know, there's a whole range of interventions that Mr. President has put in place across all sectors: agriculture, manufacturing, oil and gas, small and medium scale industries, and most of all, direct support for the poorest and the most vulnerable, particularly through direct payments to them, which are done in an open, transparent, and digitally secure way. And I think it's on that note that we can say that the reforms of Mr. President are yielding fruit, but more help is planned for the poorest and most vulnerable, particularly as the gains of the all-important market pricing of foreign exchange, market pricing of petroleum products and
each engagement was designed with the goal of strengthening macroeconomic and financial system stability and advancing a path towards sustainable and inclusive economic growth that benefits every Nigerian. During the statutory meetings and our various interactions with key stakeholders throughout the week, I reiterated the bank's unwavering commitment to remain steadfast in this path. In addition to our meetings with senior leadership of multilateral financial institutions and foreign investor groups with a strong interest in Nigeria's developments, we had the opportunity to launch the NIBS Non-Resident Accounts Program and engage with the diaspora community in partnership with Nigerian banks. Our team held productive discussions with leading IMTOs where we collectively committed to growing remittance flows to $1 billion through formal channels into Nigeria. This target is both ambitious and achievable, and we are fully committed to mobilizing resources to reinforce the collaborative task force which I am leading at the bank. The team is focused on driving progress by identifying and resolving any bottlenecks that hinder remittance flows through the formal channels into Nigeria. Furthermore, I would like to emphasize that we are consulting at the highest levels to remove Nigeria from FATF grey list, a key topic in our recent engagements. Since assumption of office a year ago, we've been focused on how to address inflationary concerns, restore investor confidence in financial markets, and stabilizing the exchange rate. Enhancing financial system supervision, fostering financial inclusion, and enhancing transparency in our monetary policy decisions and communications. We embarked upon bold and necessary reforms to return to the path of monetary policy orthodoxy, as well as remove observed distortions in the foreign exchange market. Our efforts have yielded significant progress as volatility in the foreign exchange market has abated measurably and remittances have also increased significantly. We have achieved increased transparency and improved overall supply in the foreign exchange market, leading to reduced arbitrage and speculative activities, and eliminated the front loading of foreign exchange demand. The CBN's recapitalization policy has prompted deposit money banks to strengthen their financial positions, a process expected to result in a more robust and resilient banking sector by March 2026. The exercise is expected to support the realization of the $1 trillion economy by 2030. In closing, allow me to reaffirm our commitment to addressing the challenges ahead, recognizing that much remains to be done to fully achieve our goals. Our path forward includes consolidating and sustaining current progress through an efficient, transparent market system and deepening financial and economic inclusion, particularly for small businesses, households, women, and young people across Nigeria. By leveraging smarter technologies and remote banking solutions, we aim to reduce transaction costs and expand financial access, ensuring that every Nigerian, regardless of location or demographic, can meaningfully participate in our evolving financial system. Regarding our commitment to orthodox monetary policy, let me reiterate our determination to follow this path through a sequenced approach to tackling all challenges ahead. We recognize the continued support of our key stakeholders, including investors, banks, Nigeria diaspora, and businesses. With our counterparts on the fiscal side, we have strengthened collaboration over the past year by establishing several joint committees. These committees are designed to drive actionable outcomes, creating impactful platforms for stakeholder engagement and delivering concrete solutions to align monetary policy with fiscal operations more effectively. I am confident that with our collective efforts and sustained commitment, we can pave the way for a more prosperous Nigeria that fosters robust and inclusive growth. This week has been immensely productive, and we are eager to transform our discussions and insights into tangible outcomes as we return to Abuja. Thank you for your time and attention.
I do have the privilege of being the coordinating minister of the economy. In that respect, we have formal structures. We have the economic management team, of which Mr. Governor is a member, and then we have the Presidential Economic Coordination Council, which includes the private sector as well as members of the economic management team. And in addition, we have the Monetary and Fiscal Policy Committee that we set up, and we meet regularly. Just before coming here, we met and we looked together with the Minister of Budget and Economic Planning, at what the forecast was of some of the things that you, Nancy, have just mentioned, where we felt the interest rates, the foreign currency requirements for the economy, the prospects for growth, and the key issues that we needed to address and look out for as warning signs as we continue to make progress across virtually all the monetary and fiscal indicators. And finally, we also have the regular ability, which we make the most of just conversing with one another, picking up the phone, going across to each other's offices and sitting down and discussing major issues that may come up operationally. So there is full and whilst respecting, and this is one of the takeaways really from this week, the importance of the independence of the central bank to drive its core mandate of price stability and financial stability. We have fully recognized and maintained the letter and the spirit of the law, which makes central bank independent, while at the same time closely collaborating to achieve a combined and a concerted fight against inflation in the first instance, and putting in place together policies to stabilize and then grow the Nigerian economy.
One of the key takeaways for me was I saw that as an opportunity to discuss, exchange views, and explain to many of the participants in the meetings the reforms that we have been doing in Nigeria, getting input, and of course trying to learn from their own experiences as well. Secondly, I think that process of engagement also creates an environment of trust, because a lot of the investors, potential investors who engage in collaborating with countries around the world, they come to this forum and they want to hear from you. Okay, many would have read things, but they want to actually hear. So I believe that process of engagement gives them the opportunity to understand the peculiarities, and of course to build a process of trust. And then thirdly, that also leads to what we at the central bank have been very keen on doing, which is reassuring investors. And that reassurance of the market and investors is what eventually leads to inflows of capital. Okay, be it short term or medium term or long term, it sets the tone for that to happen. And it is in that light, quite frankly, that we also engaged with a lot of the diaspora and were able to come to an understanding on how we could engage with them better. And I think one of the questions was on the issue of
Interest rates.
Interest rates, okay.
Yeah.
All right, interest rates. Now, on the issue of interest rates, and I fully take on board, the context that the Minister of Finance had set on what we have gotten from the discussions of the past few days and where the world stands. Now, we should also be mindful that Nigeria is a different case, and as much as we say that the whole world has generally started to ease a bit, and the pressure is coming off, I think the challenges that Nigeria has faced need to be put in their own particular context. Loose money supply, and a whole host of other issues that have put pressure on inflation. And obviously it is for that reason that our own approach towards managing that has been a lot more measured, if you like, than what exists in the advanced world. And I want to also make a point that even in the case of easing in many of these other countries, it's again, they take their time in doing so. The easing we talk about is not something that is done overnight or at short notice. It isn't. Okay, if you look at what happened in the UK, even in the US, it's it takes time to get to the point where you can really say you're comfortable enough to begin to bring down or moderate interest rates. We have to remain vigilant in Nigeria. We really must remain vigilant. We cannot afford a situation where inflation gets out of hand. We cannot afford it. We understand the very dysfunctional nature of high interest rates, and our own hope is that those will be things that will over time begin to moderate as we see the situation get better. And let me also say something here. The decisions that are taken with respect to interest rates in Nigeria are primarily evidence-based. They are evidence-based. These are things that the members of the monetary policy look at the data, and then they come to a conclusion based on that. One of the things that I have been canvassing for during my past few days here is how I could get assistance from many of the donor agencies and others with respect to strengthening the evidence-based process at the Central Bank of Nigeria, because I think that is very, very key as we move along this whole road of travel. Then on the issue of the discussions we've had in Houston and in Washington DC, again, context on that, it goes back to the time we came here for the spring meetings, okay, in which we were of the view that because Nigeria has such a strong diaspora community here, and that at that point in time when we were just at the earlier stages of the reforms, INTOs were identified as having issues with respect to transferring money back to Nigeria, and we felt it was important to engage them, and we did. And as a result of that engagement, we all rose and identified particular problems, of which a lot of responsibility was shared between the ILTOs and the central bank. And we got back to Abuja. We played our own part in ensuring that we took out those distortions. And we were very happy that within a matter of months between that time that we had that meeting in Washington, which was I think April and September, the time we had it in Washington, the monthly inflows was about 250 million US. And as at September, it had risen to 600 million US. And that was on the back of this particular dialogue that we had had. So coming back here to Abuja this time round, I beg your pardon, to DC this time round, see, I'm missing anything. We all do. Coming back to DC this time round, we felt there was need to continue and even expand and deepen that engagement. And that is why, beyond just the INTOs, we reached out to the diaspora. And I need not tell you that the diaspora we have a very strong diaspora who have been very successful in a lot of the things they've been doing, and you should all be very proud of what they've accomplished. And we were pleasantly surprised by the turnout of people that came for that meeting. We were very pleasantly surprised. In conjunction with the banks, a number of banks, the leadership of some of the Nigerian banks were also there, and NIBS, okay? And we had a dialogue with the diaspora to understand the issues, to understand the problems. And as a result of that, we have committed that by the end of this year, we will have a new product which will give the diasporans an opportunity to register their BVN without going through all the hassles that they have been going through up to this point in time. It will be specifically for the non-resident diasporans. Specifically, that plays to the problems that they have had. So this is a collaborative effort, as I say, and in addition to that, there are all other products that the banking industry is offering, and through engagement with the diaspora, we believe we'll be able to move accordingly. And again, rising from that engagement, we put our sights on increasing the inflows, the remittance inflows to $1 billion. And I'm confident that we will get there.
All right, welcome back from that. Do I really need to encapsulate anymore? Because you've really heard it from the authorities there, from the finance minister and the coordinating minister of the economy, Mr. Wale Edun, as well as the central bank governor, Mr. Olayemi Cardoso. So at this point in time, let's quickly take a break. Yes, I think we can do a break at this time. Let's quickly take a break, and when we come back, we'll continue the program. All right, welcome back. Let's quickly bring you the plenary session, the annual meetings, as it were, the IMF and World Bank annual meetings, where we had AJ Banga, the World Bank president, speak, as well as Kristalina Gogevia speak to the board, you know, to tell us, of course, what's been happening in the last year, how they've been using monies, as it were, you know, because I have mentioned on the show that IMF is a fund of 190 members, Nigeria inclusive, the same also with the World Bank. And the World Bank and the IMF, both institutions are commemorating their 80th year of existence. In the show previously, you've heard me chronicle that, what the IMF stands for and what the World Bank stands for. In case you didn't see that, please go on our YouTube channel and watch that. What I did at the beginning of this meetings was to educate us about the IMF, the World Bank. Are they still the World Bank and IMF we used to know 80 years ago? Should they reform to better serve the need of poorer members? But let's take a quick look and we'll be right back.
Let me start with some good news. Inflation is in retreat from 5.7% in the fourth quarter of last year. Our World Economic Outlook sees global inflation falling to 5.3% in the current quarter and further to 3.5% in fourth quarter of 2025, with a faster decline in advanced economies. Tight monetary policies have worked without breaking the back of the global economy. Big sense of relief, but not yet time for celebration. Even if inflation is coming down, the new and higher price levels are here to stay. Families are hurting, and looking ahead, the world now faces a low-growth, high-debt trajectory. We project global GDP to grow at an anemic average rate of 3.2% per year over the next 5 years. Just look at how our forecasts have been revised lower and lower over the years. At the same time, we forecast global public debt to keep rising, with a risk that it could exceed our baseline projection by as much as 20% of world GDP in a severe but plausible negative scenario. $100 trillion in government debt worldwide, higher interest rates payments eating up a growing slice of fiscal revenues, especially in low-income and emerging market economies. All of this while spending pressures pile up. Spending priorities include outlays related to climate and demography, and in emerging markets and low-income economies, investments to close the development gap. By 2030, IMF research sees these spending pressures adding some 7% of GDP to annual expenditure in advanced economies, 9% of GDP in emerging economies, 14% in low-income countries. If you think it is tough now, just imagine how tougher it will become. To make matters worse, the world is fracturing, and trade is no longer the powerful engine of growth that it used to be. The retreat from global economic integration, driven by both national security concerns and the anger of those who lost out from it, is visible in a mushrooming of industrial policy measures, trade barriers, and protectionism. There is much work to do. My message to our members is this. First, shift toward rebuilding fiscal buffers. Second, invest in growth-enhancing reforms. And third, work together to tackle global challenges. With monetary policy easing, fiscal consolidation should start now. Credibility requires persuasive communication with the public. Multi-year fiscal plans should lay out consolidation paths tailored to country-specific circumstances. This is not easy. Governments face a dilemma, more accurately, a trilemma of large spending needs, political red lines on taxation, and the need to rebuild buffers.
Before the end of the year, we will launch a project preparation facility, funding it from IBRD income to help countries with capacity challenges and take ideas to bankability. We've got a new mechanism to enhance the value of callable capital, a request for quite some time, that is now ready for shareholders to be able to bring it to life. We've taken substantial actions on the pricing of IBRD loans so we can ensure that middle-income countries can borrow from us in better terms. Part of that pricing adjustment, crucially, allows small states eligible for climate-resilient debt clauses to borrow at our lowest pricing tier. These elements are all part of a sustained effort. The method in the madness is, whenever and wherever we see an opportunity to improve our balance sheet, to optimize its use, to help our clients, we will pursue it. Because when more affordable financing is paired with our knowledge, it just creates a really powerful engine for development. That same spirit of doing all we can is ingrained in our IDA replenishment campaign. Over 6 decades, 36 countries have graduated from IDA. Many of them are now generous donors in their own right. What they do know is 3 things. The first, the power of IDA, its grants, its deeply concessional loans. 2, its knowledge that's gained over the years that helps to build capacity for other countries, that transmission line that Kristalina referred to. Third, IDA's unique capability to multiply every donated dollar 3.5 to 4 times. That gives donors more impact per dollar. It gives clients the ability to take on bigger developmental projects. That's what's helped IDA deploy $270 billion in the last 10 years. IDA is just the best deal in development. There is no better one. More than the funds we deploy are the benefits that people derive. Over the past decade, IDA has helped deliver health services to almost 900 million people around the world, connected 117 million people to reliable electricity, and delivered clean water to 94 million people. It's helped more than 18 million farmers grow more, waste less, and improve their bottom line. Meanwhile, IDA is a lifeline for the world's 78 least well-off countries that will spend close to half of their revenues on debt service this year, as the chair was referring to, and much more than they spend on health, education, and infrastructure combined. In that environment, IDA has provided $16 billion over the last 4 years to the 4 countries in the common framework that the IMF and World Bank have been working on together with the G20.
Get started. Tobias, when we released our last GFSR in April, optimism in financial markets was fueling asset valuations, credit spreads had compressed, and valuations in riskier asset markets had ratcheted up. At the time, you warned of some short-term risks like persistent inflation, as well as the tension between these narrowing credit spreads and the deteriorating underlying credit quality in some regions. But you also warned of some more medium-term risks like heightened vulnerabilities amidst elevated debt levels globally. So where are we now since then, 6 months later?
Yeah, thanks so much. And let me welcome all of you to this launch of the Global Financial Stability Report. So the themes that you highlight, Alex, have broadly continued. So let me start with inflation. So global inflation has progressed towards target in most countries. Most central banks continue with a tight stance of policy, but have started to cut rates. Now, with inflation heading towards target in many countries, the focus of the central banks has shifted from being primarily focused on inflation towards also considering real activity. And so concerning real activity, we have seen upward surprises relative to expectations in financial markets that has been particularly visible in earnings surprises that have been on the positive side. And so as a result, the likelihood of a global recession has continued to recede. So the baseline forecast is one of a soft landing globally, and that is the optimism that we had flagged already in April that has been reinforced in many ways, and that is fueling optimism in financial markets. So financial conditions globally continue to be accommodative, credit spreads continue to be tight, implied volatility, particularly in risk asset markets such as in equity markets, continues to be fairly low. Now, our main theme in Chapter 1, which is released today, is a tension between this financial market assessment of volatility, i.e. the implied volatility in the equity market is perhaps the best indicator here, which is at fairly low levels by historical standards, relative to measures of global geopolitical uncertainty. So in the report, we're showing 2 measures that are computed not at the fund, but by other institutions, one on geopolitical uncertainty, the other one on economic uncertainty, and those continue to be relatively elevated. So there's a kind of wedge in between the financial market implied volatility and the assessment of political or economic uncertainty. And so this tension worries us as it gives rise to the potential for a sharp readjustment of financial conditions. And so we saw a little bit of that in August in a sell-off that was very brief. So it's a blip in retrospect, but it does raise the concern whether there are some vulnerabilities in the financial system that could be triggered if adverse shocks hit.
Yeah. Thank you, Tobias. That sets the stage nicely for us, I think. We will turn to your questions now. We do have runners in the room with mics, so please do raise your hand. You can raise your hand both online or in the room, and we'll come to you. Please do remember to state your name and affiliation, and keep it brief as possible so we can get to as many questions as possible. Let's start over here with the first question.
Thank you so much. My name is Simon Ateba with Today News Africa in Washington, D.C. I'm now asking you to comment on the presidential election in the U.S., but we have a presidential election here in 14 days, and President Trump or Vice President Harris may win the election. And that election will have ramifications, not just in the U.S., but around the world. How does the IMF assess the outlook for the U.S. economy in the lead-up to the presidential election, and what implication could potential economic shift have for emerging markets in Africa, particularly regarding investment flows and debt sustainability? Thank you.
Yeah, thanks so much.
Do you want to group some questions?
Sure, absolutely.
Do we have any similar questions on the election or the U.S. On other? Can we take the question over there, please? Thank you.
Miranda Zalfa, EF Consulting. How do you explain the recent backup in U.S. yields? And are you concerned about financial stability in the United States, given the rising projections of federal debt, irrespective of the outcome of the election? Thank you.
Thank you. I think we can start with that for now.
Okay, sounds good. Yeah, so we don't comment on specific election outcomes or so. Of course, this year is an unusual year in that over half of the population globally either has elected already this year or will elect this year new governments. And so that is certainly part of the reason why this policy uncertainty globally is high. There's some uncertainty as to what the policy path for economic policies and broader policies is going to be going forward. When we look at volatility, as I said, that uncertainty in equity markets is relatively contained. But in interest rates, volatility is somewhat more elevated than it was, say, in the decade after the global financial crisis. So we are back to levels that are more similar to pre-financial crisis. So interest rate volatility is relatively high. And that answers to some degree the second question. We have seen volatile longer-term yields throughout the year. But we don't think that that volatility is excessive relative to the fact that monetary policy has become more data dependent. After the global financial crisis, there was this challenge at the zero lower bound for monetary policy, and so forward guidance was a very important tool. And that had even been phased in prior to the financial crisis, with forward guidance being a compressor of volatility for interest rates. And that is less the case today. So interest rate volatility has increased. When we look at the longer term yields, we do certainly see that term premia have decompressed to some extent. So after the global financial crisis, we had seen negative term premia at the 10-year level in the US and many other countries, and some of that has decompressed, and that is as would be expected as interest rate vol is coming up. asset purchases are normalizing and quantitative tightening is being phased in. Now, turning to Africa, of course, financial markets are global, so the base level of interest rates is moving across the world in a common fashion. And so you can think about sort of like the base level of interest rates and then the spreads in countries relative to that. So what we see in sub-Saharan Africa is that countries with market access, so those are the frontier economies, they have seen spreads being compressed. So financial conditions have eased, and relative to say 12 months ago, interest rates have certainly declined as a base. And many frontier markets have reissued, so have accessed international capital markets. So of course, there are countries that do face debt challenges, that do face liquidity challenges, and we're actively engaged with the membership to address those. Do you want to add?
Just to quickly add to what Tobias said about Africa, I think, as he pointed out, the backdrop heading into this year was one of improvement, both in terms of growth as well as financing conditions and spreads. Inflation is still high in the region, but it is coming down and stabilizing. That is an issue, but we have seen several cases this year being resolved, so that's good news. I think to your broader point, we don't comment on election outcomes, but we do know that financial markets tend to see more uncertainty around those outcomes, and this may affect financing conditions around the world, including in Africa. Uncertainty can also bring some slowdown in investments in the near term or the medium term. And so those are all possible outcomes. I think the key thing is for the macroeconomic framework to remain stable to address domestic situations, and for countries that may be facing debt issues to engage with their creditors early, including through the common framework and other international setups.
Thank you. Can we take other questions? I think we have a question here in the middle, at the center. Thank you.
Hi, good morning. Greg Robb from MarketWatch. I was hoping you could talk about quantitative tightening. The Fed is still doing it. What are the risks now going forward? When do you think they might have to or might stop it? Thanks.
Yeah, thanks so much. So as I mentioned earlier, during the global financial crisis, and then in the decade after the global financial crisis, and then again with the COVID crisis, central banks, advanced economy central banks around the world engaged in quantitative easing. So these are asset purchases called large-scale asset purchases in the US that led to an increase in the balance sheet size of the central banks. So in the US case, it grew roughly by a factor of 10. And the Fed has started to move towards a normalization of the balance sheet size. So that is generally referred to as quantitative tightening, and that has proceeded in a very orderly fashion. So when we look at market functioning, we see orderly markets in money markets. We see ample liquidity in core funding markets, including treasury markets. And that is generally the case in other advanced economies that are doing quantitative tightening as well. Of course, there is the question of how far the balance sheet normalization is going to go, and policymakers in the US and other advanced economies have indicated how far this normalization would be going. So, what is notable here is that the operational framework of the Federal Reserve changed to a floor system. And so having a sufficient amount of reserves in the system to operate that floor system
Welcome back. And at this point, it's a wrap. Thank you all for joining us again today. I am Nancy Naji. Be the best you can be and be the change that you want to see. Bye now. Thank you for watching. In case this is your first time watching us, thank you. Don't forget to subscribe to the channel, drop your comments as well as like, and most of all, share our content. Bye.